Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, May 31st, 2024. So we are in the last trading day of the month here, and I'm going to do an update on, as I usually do, I'll start out with the equity market. Somebody asked me to include SPY. I've been focusing a lot on QQQ and the NASDAQ, the Russell 2000. I followed up, if you missed it, in the post that I got out to you earlier today. Here, let me show you. This one here, the NQ and QQQ at resistance, proved to be a very timely post. And remember too, you got it right. We were there. You didn't have a lot of time to think, but this is why I do these videos each and every day. This wasn't a random, hey, check this out, it's a good shorting op. These are levels talked about in advance. That if we push back to that downtrend line on QQQ and or the futures, that was the same downtrend line right there. We had that short the other day. So that's the downtrend line in play right now, the one to watch. And so nice rejection so far, or I think we already hit that 8,400. I'll get to this in 1 second. I just want to say it was in that post. And these also, I'm going to get to SPY in a second. It was at least a couple weeks ago. I said these are near-term targets, these uptrend lines coming off the mid-April lows. So I'll show you how it looks on SPY. So that was NQ. I'll just follow up real quick. So this is the hourly chart I just showed you. So that's, on the hourly, as you can see this morning on the one I got out to, we were right here at the time. I don't have any, there's obviously you're going to have a reaction. Well, no, we already shot through there. But somewhere in here, we'll most likely hiccup. But I have no desire, if you're swing trading, this is my go-to swing trading time frame, to play a counter trend bounce as a swing trade in those longer term accounts, that I position in IRAs and things like that, till at least we get down here, and then we're going to bounce. That's your kind of near-term target, which still has, if you shorted it today, if you shorted the bearish engulfing candles, you're already up about 3.5%. But if you took that shot today, we're already up. We've already reversed 2%. I'm just measuring here with the line. If we hit that intersecting trend line in 18,080-ish support, that's about a 3.2% profit or drop from where we were this morning at that downtrend line. So that's how it looked. That was the 60-minute chart I gave you, and I also gave you this 5-minute chart. It's kind of just zoom in for you active traders. That was the level there. And so I'll get to the SPY in a second. I'm not going to forget that. But I wanted to kind of talk about this. I've highlighted it here. We've had a couple of these small divergent lows that I've highlighted, and we got the expected bounces or reactions. Remember that one there? So if we take out the trend line, we'll probably come up here, and then you'd have a good shorting up at any of those nearby resistance levels. But this is right now a change of character. Because when we're in a uptrend leading up to this, you usually get these little 15-minute, all the better, 60-minute even better, but even those little 5-minute divergences often were the catalyst for the thrust to either new highs or at least rally well into the mid to high single digits, if not double digits. Well, usually single really. Market's pretty, not that much even up year to date. But either way, I just wanted to say my point being that nice, clean, bullish, positive divergence, that's all got us there. And so the way this game works, or whatever you want to call it, of trading, the process of it is, first and foremost, you need to have an opinion. Me, I'll tell you when I don't have opinion at all. I'll tell you when I have an opinion, but my convictions aren't strong, and if my convictions are strong, you're gonna hear it in my updates, in my voice. You're gonna hear it in frequent updates. And so when you believe that, if you do believe, as I do, that may be the top, only time will tell. That big bearish engulfing the other day, or at the very least an objective shorting up, and you think there's more downside. It's that simple. If you believe that the trend has changed and this correction is not over, has more downside to go, then it's very, very, very simple to trade. If that's your belief and you're going to have a trading plan, you're going to stick with it, you want to short rallies into resistance. You can cover the dips if you're an active trader and game these little squiggles like I like to do. Or you can sit tight. Again, I spoke to both the active trader and the swing trader this morning, saying that was an objective short entry for both. Whether you're an active trader and you just want to game, and if you got that, you shorted that, boom, you just made already enough right now to book profits for the day. And I don't think there's an active trader out there. I can promise you there's not that wouldn't take a quick, couple hour 2% move in the Nasdaq 100 futures. Active traders, active trading, which it's day trading or swing trading on a very short time frame, a couple of days, weeks, you tend to take higher position sizes. But day traders by definition do, because there's no overnight risk. To me, I've kind of morphed that into, because the futures trade around the clock, Sunday evening through Friday evening. It's really, there is no daytime. Unless you go to sleep, obviously, but you can manage and control your loss by having a stop loss order that will get hit anytime you want it to in the 3 in the morning. Stock traders and ETF traders can't do that. Number one, you have to the liquid after hours and pre-market trading is only a few hours, but more so you can only use limit orders. And the problem with limit orders, I always talk about this, is they can get bypassed. So even the most well-placed limit order, let's just say you shorted here and it was QQQ, and then you had a stop loss right here, and let's say you did this and then the market closed right here today, right, right a little below, and you were a little bit profitable. But then tomorrow it gapped up. I know tomorrow's Saturday. I'm just speaking, in this example. The next day it gapped up right here, just a hair above your stop, and never looked back. Guess what happened? A stop limit order will sit there and hang. Stop limit order says sell if my stock hits this price, sell at that price, but no worse, only better. That's how a sell limit order, whether it's on a buy stop or sell stop. Now, a stop loss order, once the price is hit or exceeded, then instantly converts into a market order. So you don't have to wake up to unfilled stop order and say, oh my God, I only, I allotted myself, 3% loss potential on that trade. And now the dang thing gapped up and I'm already down 6-7% at a loss, and it's still going. What I do. So it takes that part of it out there. So and that's what, again, futures, you can use stop loss orders or stop limit orders if you want to. I like the stop loss orders. All right, enough on that. Okay, so on that post, going back to the bottom here, right after I threw it out there, I'm like, okay, I should have included this for you, because remember, the small caps and the Nasdaq 100, those are my two main trade. I would usually trade both. They're both risk on indexes. Small caps are more rate sensitive. I'll try to get to bonds in this in a second, but this was just a beautiful downtrend line. And again, talked about in advance here. In fact, let me pull over the other RTY. So RTY, this was. I've covered it in some of the videos, as well as IWM recently. And if you're an ETF trader, you can just replicate these levels. Sometimes you don't have all the reaction points that you get on the futures, but same thing. So this was back here on the 21st, so 10 days ago. Told you we just put in this divergent high, beautiful little divergent high, right, on this 60-minute time frame. Just like that divergent high and just like that divergent low gave us that divergent low. I already covered this many times. But then, boom, there was our sell signal under 2097, targeting 2035. I just updated it yesterday, the day before, when we hit that level. Told you we're probably going to bounce there, and then where you could reshort. So that was then. This is now, today. That was the 2035 level. You can see it. It was said 2035 on that original chart. Sometimes when I'm drawing and annotating, it moves. So it's moved up to 2039, but I had it at 2035 originally, which is almost exactly where it hit right there. You bounced, and look where you bounced to. So you could have, turned around profit on long. You had positive divergence. And then, and I mentioned it then as a bounce candidate. Cover the short, take profits because that was good support. You bounce right back into the same downtrend line today. Again, comparable downtrend line. This is a whole different index, but it's not mere coincidence that, SPY, QQQ, they have these nice clean downtrend line off the high. So again, the takeaway, there's no guarantee where we go from here, but, guaranteed that was an objective short entry earlier today, this morning. And that was then, got that out right after the open, 9:37, you can see it. And let me do an update for you on that. RTY, where are you? We got a lot of charts going down here. That was it. So you can see, you have to look closely. There's the rejection right there off of Okay, had to pause it there a couple minutes. Had to take an important call. What I didn't show you on that, I just zoomed in there to show you the rejection. So again, that's about a 1.5% drop on small caps, right off. Nice rejection off the trend line. But what I didn't show you, and I'm going to draw it in here. Nice little potential divergent high potential because we need to make a bearish crossover here. And again, so that's the small caps. And that's that. Nothing much more to add. We've already hit this. It was a pretty significant support level and target. So I think if we can clear on down through, it's more of a target zone. 2000 or 2022-ish. Pretty good support. That should open the door for more downside. Okay, so that was that. Somebody asked me about covering the S&P 500, so let's do that. Here's SPY. Remember, this is the whole, reason for both swing and trend shorts, that potential topping stick, bearish engulfing candle. Very, 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 like I said, one of my favorites. It's like, I'll take them all day long. And, like I said before, you can take 10 shots on them when they look good. Again, you got to look for them in the right place. It has to be at the end of a prolonged uptrend. It's got to be a topping stick. That one's bearish engulfing, but not the top. This one was so far. And again, your stop was or still is either right above there if you want to give it a little room, or you can lower down to break even if you waited to the close that day. As far as levels, let me go to a 60-minute chart. I'll probably have better levels there. Same thing, same trend line. This is what I covered a couple weeks ago. I've highlighted these a few times on the 60 and 15-minute charts. That's an uptrend. They're probably going to step in and buy. We're going to be pretty near-term oversold. But bigger picture, you want to go big picture. Okay, let's just for 1 second entertain the fact that that could be the top. Those bearish engulfing candles may or may not be. I don't care. Only time will tell, and we'll see. But this is on a weekly chart. These are, still, my bear market targets. These were laid out back here at that top. We were short there. I give you a couple near-term and then longer-term targets. Long-term T1 was hit, and that's where we reversed. We had a reaction. Some might say, well, that's, of course, it was not anything we, stayed short through. We expected a bounce there. We had positive divergence, everything else. It's been a strong reaction. It was largely, the fact it made a new high was exclusively attributed to the overweighting of the Mag 7. That was well documented. That's not just my opinion, or, it showed that they contributed. I've seen the statistics. I don't have them in front of me that, 80-something% of the rally was attributed to the gains in those guys because, again, of cap-weighted index. In fact, somebody even mentioned that in the that post today right here. Kevin K, an observation, he went on to say how market breadth, the NASDAQ was down yesterday, S&P was down, NYSE, and the breadth was good. More stocks advancing, declining, the market's going down. Just the opposite of what happened over the past year when half the decliners led advancers, a handful of stocks. Exactly, and he's right. And so my answer was, yes, the formerly known as Mag 7 stocks got too top heavy and will ultimately collapse under their own weight. They dragged the market up on their way up despite poor internals. And again, let me put a little asterisk in there. There were brief periods where we had improvements and better, and positive market breadth. But I'm talking overall throughout the bulk of the run. The majority of it was non-confirmed. I even went over that yesterday on some of my breadth indicators in the video I did. And they will drag it back down with them when they fall, whether breadth is positive or negative. Why? Because it's simple mathematics. Those handful, those top 7 or so stocks, they still some might not be magnificent anymore, but they all still have a tremendous weighting because the S&P 500 and NASDAQ 100 cap weighted index. That means the bigger a company gets as far as its market cap goes, which is, if you're not aware, then you add up all the shares outstanding times the number of times share price. That's what a company's worth. That's why, Microsoft being a $3 trillion company, and a lot of these companies around there, and most people can't even grasp how big $1 trillion is. And so those indexes, because they have those big weightings, they can move, those just a handful of those stocks need to be down one day, and every other stock in the NASDAQ 100 can be up. Doesn't matter because of the weightings. And it's more pronounced, by the way, guys, in the NASDAQ 100. So And I went on to say, too early. This is too early to say this is anything more than just a few days. Maybe that's just a brief, aberration here where you're seeing the positive breath. I didn't confirm those numbers. I'll just take them on faith. Again, it doesn't matter. Nothing matters but what the big Mag 7 do. And as I've talked about lately, it's been, pretty much the Magnificent One. And as I've commented on that many times before, the rest of the lot, meaning the other Mag 6, will drag NVIDIA down sooner or later if and when the correction's big enough, because it's simple, again, mathematics with inflows and outflows. Remember, QQQ, the NASDAQ 100 ETF, tracks the NASDAQ 100 as well as the NASDAQ 100 futures and mutual funds and everything else. When people are pulling out because there's a correction, they don't like the fact things are dropping, they're booking profits, whatever reason, the market's going down, well, these indexes sell what they have proportionally. So NVIDIA is a great company. Oh my God. I mean, they're just making tons of money, big profit margins. But unfortunately, the same effect that's dragged the indexes up with, if all the rest of the Mag 7 or whatever stocks break down, Microsoft, Amazon, they start going down, the index goes down, the index is losing value, they're going to, NVIDIA is going to get sold out of it. Proportional, at least from those index ETFs. That doesn't mean there can't be an offsetting inflow from institutions or individuals buying the individual stock. There is that too, guys. I'm speaking kind of generically in just how that works. So, money's coming into the indexes and people pumping in their 401ks and buying index funds, including the S&P 500. Every dollar that goes in gets trickled among more of those, more of that money goes in to the big Mag 7 than goes into the rest of the lot, all the other stocks in there, and it works the other way around in reverse. So I just want to point that out. All right, back to the S&P. I'm taking a long time to do this. That's it. So those are the again, that's long-term target, hit T1 there, divergent low. Market rallied, certainly more of a rally than I figured we'd ever get out of that, but it is what it is. And again, semantics, if you want to call it a new bull market, you want to call it a bear market, you want to call, really, we're still in a secular bull market within the indexes all along. This is, the whole thing really started back here. If you want to say off the '09 lows, this is the primary trend line right here in blue, and I showed it to you on the weekly. So, these are just longer term targets. I hate to even talk about them now. They're so far out. And when I do, sometimes you get the people, oh my God, we're going to take it step by step. I don't think very few. Somebody asked me yesterday, hey, if I want to just tuck things away and short the NASDAQ 100, not worry about the, gaming the zigs and zags, what to use, is SQQ good, the triple short Q. Yeah. Typically, and you can read about this in the FAQ page on the site, I had a whole thing how the mathematics work. The more leverage an ETF has, the more you get that decay. And, it actually works in your advantage. I want to just expand on that. It can work in your advantage. If you go to resources, click on FAQ, frequently asked questions, go to ETF related questions right here. And then I talk about the disadvantage of holding those leverage ETFs for an extended period of time, and I give you the math right here how it works. It's again, everything boils down. A lot of things do in the stock market to simple mathematics, and so I do this, and I feel strong on this because I'm sure somebody out there has picked up on this besides me, but there was been so much negative PR about these, how horrible and awful, and they should be banned. I'm talking about leverage ETFs, whether they're inverse or bullish, because of this whole effect here. Well, guess what? It typically works against you, but there's some variables, and I would encourage you to read this. Basically, the more volatile something is, think GDX, gold mining stocks, think VIX, think natural gas. Those things are very volatile. You're going to have the decay, the effect, because of this mathematics, the mathematics I explain here are going to be worse. However, I go on to say, if you get in a what I call a unidirectional trend, where it's mostly up, here's a unidirectional trend right here on the S&P 500, right there, you will actually outperform the underlying index, even when accounting for the leverage. In other words, if you're in a 3-time long ETF, and it goes in the underlying index or security you're trading or sector, whatever it is pretty much going up almost every day. By the time you're done with that trend, if you get out right before it reverses or starts consolidating, you should have done better than 3 times what the index did. Again, I explained the math in there. However, where you're going to lose and decay and do less than 3 times, of course, obviously you don't. It's a given if the thing goes against you, but it's these choppy sideways periods here, and I'm just picking the S&P, and I'm on a weekly chart here. Here's a great example. We'll go down to when the market was consolidating earlier this year. This is when you don't want to own them. And sometimes you can get that for an extended period of time. And you got to look at it on the daily chart. It doesn't matter. All it matters is these daily closes. That's, again, what I explained in that section there. So if you read up on that, you understand a little bit better. And I will actually utilize those sometimes in some of my accounts, or if I want to trade things that don't have futures, like the gold mining stocks, Nugget and Dust. They used to be 3 times, and then they chopped the leverage down because they were at risk of blowing up. So now they're 2 times. I know I'm talking fast. Nugget's the 2-time gold mining bullish ETF, and I'm going to get to the miners here in a second. And then Dust is the 2 times short. Again, they used to have 3-time leverage, and I've highlighted these recently. The miners as a short trade. So my answer, to make a long story short here, was that, look, if you're going to hold, you're probably best off, and I can't give any individual investment advice. PSQ is a 1-time non-leveraged inverse, meaning short, QQQ ETF. So there's no leverage there, so no decay. It should, all things being equal, every ETF has its little expenses, but it should roughly give you an almost perfect mirror inversely of the NASDAQ 100. And if you want a little less leverage, and again, on the indexes, I don't mind the 2 times. If you're looking at a trend that might last weeks or months, if you have a pretty good degree of confidence, it's going to be pretty unidirectional. Again, this is where the decay happens. It's chopped back and forth because of the math I talked about. This is where the leverage ETFs are fine. We can't always get that, but I try to do my best to identify when we're going to get those. I think there is a big chance. I told you, I had my customized NASDAQ Hindenburg indicator just fired. I've bullish sentiment is sky high, short interest is low. So these are the times, and I talk about them, when I think the risk of a sudden and swift drop is elevated, and that time is now. And that's not often. I talk about that every so often, maybe a few times a year, not very often. I'm always, long or short, not always, but often, always every now and then pointing out, objective levels to go long, cover shorts, and or go long, sell those longs, reverse to short. But there's not a lot of times I talk about the potential being elevated or the risk of a, we call it a market crash, call it whatever you want. I'm just talking a swift move down. We haven't seen one in a while, but that's some of these moves right there. So, all right, guys, let me move on. So that's it. So basically, and if you want to short the SPY and you don't want leverage, SH is your 1-time, and then SDS is your 2-time, or you go with SQ, or what's the SO? Gosh, it's been so long since I used it. Forget it. It's eluding me right now. But let me get to the other things I want to cover, and I can wrap this video up. So, all right, you have my targets. There's QQQ. We're coming up on that trend line there. That's a swing target. Oh, we just hit it. Look, boom, trend line. Let me check the futures. NQ, not there. So it's a different trend line I have. I'm coming off. This one's April 19th. And then May 2nd. And see, this is an example where you have different lines because you have different reaction points on the futures. This was the same lows. Oh, that's what I did. On the futures, I had it there. And you know what? I'm gonna drag that down right now. I'm gonna leave it there. It matches the one I have on the futures. I do have a price support level, so we could bounce here. But again, I told you yesterday, I'm kind of morphing to getting in that mode where I'm less apt. I will game, and I did game some of these short-term bounces on the 5-minute chart with when we fell to support or price targets had divergence, but I'm getting less and less keen to do that now because, again, I think we've hit that point of recognition where, and today was a good example of that in pre-market. You see what happened? The Fed's preferred inflation gauge, the PCE, came in pretty much on expectations. The market rallied, and then boom, they sold into it. So you're getting this. This is just, that's a slap in the face for the bulls when they see that and they, okay, we're going to rally today because PC didn't come in too hot, but there. And of course, to be short and bearish the market is to be long and bullish the VIX. Simple stuff. We have that divergent low. These are the futures. Had that initial pop, second pop, pulled back. We came back to that support zone. I believe I highlighted that the other day within the last week as an objective re-entry point for VIX. And so once we pop this level here, again, as I covered recently, it should take us up to those next targets there. Those are the futures, spot VIX, or you can use any of a lot of VIX tracking ETNs out there. That's it. Coming off that divergent low, rallied up. I think I covered it here the other day. So there's a uptrend line. We hit it, bounce, pulled out. So once we take this out, again, I think we'll, if we go down to the 200-day moving averages, which I know I'm jumping all over the place here, you still have these targets, which have not changed. These have been here since we shorted back here. Again, this is a marginal new, ever so slightly high, not high enough. If you've been riding this whole thing out, I told you, me as an active trader, I reversed covered shorts off T2, getting bounced, but some of you might have stayed in, keeping your eye on the ball for these longer term targets, and you went slightly underwater there, but not enough to take out any reasonable stop based on a favorable RR risk reward ratio if shorting here and targeting T5 or even T4. So these are the 200 days. I still think we're going there, and when we get around the 200 days, that's when traders, both human and machine, will step in and start to buy. But I also talked about, this is what I do in these videos, why they're long-winded, the fact that we start taking out these levels. I think there's a potential for a pretty big slide, and then you'll have that what I call momentum-fueled overshoot. You're probably going to overshoot the 200s, hit one of these two price targets, T4, T5, or maybe it'll be T3. We'll see. And then snap back up, and they'll try to close the week or get back on those 200 days. But also remember, once broken, they act as resistance down below unless they're recovered. And you can also trade on a weekly time frame. The 200-day on a weekly chart, you just need to plug in 40-day moving averages, because it's a 40 period really is what you call it. So a 40-week moving average is the same as a 200-day moving average, because there's 5 days in a week. 5 times 40 equals 200. So that's what these are right here. Those are the 200-day moving averages. All right, so you have the some near-term targets. Again, I kind of pulled that line there on QQQ. Maybe they step in and buy it here, but see, SPY, I've got a little more downside. So there it is. So it should be a little more downside today. We're down 0.74%. We'll probably get down about 1% or so, at least in SPY today, before some buyers step in. So we're down 1.79 on QQQ. Again, let me just look at the equal weighted, see if what Kevin said's holding true still. Yeah, look, 1.47 on the equal weighted, coming up on support actually right there. But we've also just taken out that trend line. So there's the daily chart, what it looks like. Remember, the equal weighted never made a new high. It's still below the previous highs there. That's just fibs. TLT, 30-year Treasury bond ETF, still below that trend line. And so we had a, little rally here with the PC wasn't so hot. Treasuries have rallied recently, but we're still below the downtrend. So there's no change. It means yields are in an uptrend, bonds are in a downtrend. IEF remains in my orange zone right there. Trying to take out this downtrend. Took it out. It's back testing right there. But this will depend on, again, like I said, at this point in time, I have a lot of evidence I've covered. Pretty strong case to be short the NASDAQ 100, to be short the Qs, as well as the small caps, or SPY if you want to be. So I am right now not as concerned what the Treasury bonds do, because again, you may see that flight to safety bid, meaning institutions now see what I see, or they see for other reasons. They want to get out of NVIDIA and Microsoft and Apple and all that, and they want to get out of, pare back on stocks. And where they're going to put the money, institutions will typically flock into Treasury bonds as a flight to safety bid. So there is a scenario, a very real and likely one, where you can see bond prices going up, yields going down, but it not be bullish for the stock market for that reason. So again, but there is no scenario on the other side. If bond prices go down, rates are going up, especially if those recent lows are getting taken out, and I see no spin or variation where that's bullish for the stock market. So All right, just like the stock market, SOX was thrown out as a trade idea back here. It put in a bearish engulfing candle there. It hit our first target. Never hasn't made it yet to T234. If you shorted anywhere around there, again, a marginal new high. If you're targeting these, would not have exceeded any reasonable stop. I make a lot of terms up in trading investing. One of those is I always say, if patience is a virtue in life, that's the saying, patience is a virtue. Patience is an absolute necessity in trading and investing. So, if you sat tight, I think we'll get down here. Again, we ever so slightly took out the top of that bearish engulfing. But again, if you're going off on, if you have a trading plan and you have a stop losses over here, it hasn't been hit. Or again, I highlighted it the other day as a new short entry, just like QQQ. It could be the same one or it could be a new one for you. It's a new one for me, as I told you. I went on vacation. When the Qs took out the downtrend line, that was where my stop was hit, and then I re-entered here. And then this is SOX, but it's going to mirror it pretty much. And then a beautiful, such a well-defined uptrend line, potential island reversal top. Impulsive selling, bearish PPO crossover. Again, the divergence was there. It's even bigger now, which meshes with my analysis. We're going to have an even bigger drop than this one right here, which was double digits. So there's your update on the semis. I've had quite a few price alerts go off today and recently. I'm going to show you some of them. I'm going to move over. I have a lot of multiple monitors. Hopefully you can see this now. These fired today. These are some of the silver miner stocks and silver ETFs. There's PAAS, if you can't see it, that's Pan American Silver, I believe. SIL and SLVP are two silver miner ETFs. And Applied Material, one of the ones that put in a bearish engulfing that I highlighted last Thursday, not yesterday, the week before. I'm going to go over those now. Oh, hold on. I also had some other alerts go off recently. I want to just show you. Let me click on these alerts, historical alert log. 7 days. Well, I can just tell you here. I'll show you. I got to pull this back over. We had these also KLAC. KLAC is the other big chip equipment maker. So remember, guys, I call those guys the canaries in the coal mine for the semi sector. The semis, to me, are the canary in the coal mine for the tech sector, and the chip equipment makers, namely those two, KLAC, which I highlighted in that recent video with a bearish engulfing candle, divergent high, and today I had a nice big breakdown there, sell signal there. And I'm sorry, that was yesterday. It gave me the alert yesterday. I just showed you. And boom, we're already close to my first target now in one fell swoop, down 4.22% today. But the takeaway, besides the fact I highlighted as a trade idea, is also this is just getting started. I see a lot more downside based on the charts. Right or wrong, that's what I see. This is not commensurate. This 4% drop isn't commensurate with the scope of these divergences. But we'll see. And then the other one, as I mentioned, AMAT, that one fired off today. I must have had a price alert under 214. Also put in, as I told you the other day when I did that video a week before yesterday, bearish was one of the ones when the market made a new high. We had a lot of stocks put in these bearish engulfing candles, including SPY and QQQ. And then boom, so I covered at the time, told you next short entry would be on a break of the trend line, and then really wanted to see it under this level. So I think I set that alert during that video, 214.63. So if you had an alert there, you would have had plenty of time to get that today. It didn't gap down below there. It took it out. It's been moving steadily lower. So that is an objective short entry as well. And still, like everything, I think it's coming down to at least this uptrend line. That's and intersecting 196.45. But again, I look at this divergence and it has the potential to do more than that. So I'm going to continue to monitor these, both as existing trade ideas as well as tells, if you will, for the market. And then, as I told you before, NVIDIA will get dragged down, kicking and screaming with the rest of it. I mean, it's got the big divergences. It just keeps going up. But, I mean, everybody was just tripping over themselves, foaming in the mouth, bullish on this stock. And again, great company, but it's not about that. It's never, sometimes shitty company. Look at AMC, GameStop, these meme stocks. Look at Bitcoin, no earnings, no nothing. Technicals matter. You're going to trade, you want to trade off fundamentals, great. If you're Warren Buffett and you've got, a 10-year time horizon and his skills for picking stocks based on fundamentals, more power to you. I will speak to fundamentals all the time. I do have a background in that. But when given, one or the other to trade with, forget about it. I mean, technicals all day long. When the technicals and fundamentals align, that's one of your best trades. But the technicals are going to determine where a stock is going, and they're pricing in everything known. What you don't see and know about insider trading, rumors that those in the know usually start buying before you read about why they're buying in the headlines. Likewise, they start selling, and then later on, only long after the technicals have played out, the stock's down, they'll come out, all these hindsight analysts, and tell you why the stock dropped then. So anywho, there's no sell signals on it yet. It's just rolling off that big divergent high. But I believe it'll get dragged down again, kicking and screaming with the rest of the lot, meaning the Mag 7, because it is part of the, it's so heavily indexed and overowned and overloved and undershorted, by the way, all those as well. Oh, so let's roll in. I already kind of teased you with the sell signals on the miners. So GDX I threw out to you. T1 hit back here, pretty much hit again. Oh no, T1 was hit right here, again close enough. R1 resistance, these are still potential swing target zones. For that to play out, gold's going to have to take out T2. I threw out gold. This is a 60-minute chart. Put in that divergent high. Put one in there, went down. That was S3 at the time, I think I had. Those were the levels on S1, S2, S3 were on GDX. This is gold. Either way, still fourth potential target. So I have to move these over. I covered this in recent videos. And I might have posted some static charts. So you can see we've been dancing on T2, my second target, which is support at about 215.40 for a while. So if and when this goes, it should open the door to these next targets, and that should bring GDX down to those lower targets. The ones that I showed you today that I had price alerts on, Pan American Silver starting to crack. It's, again, I always say if you have to squint, give it the benefit of the doubt. If this prints a solid daily close or gets well below their intraday, then that's a breakdown. Right now, it's close enough. My alert triggered because we've just ever so slightly crossed the trend line. To me, the breakdown appears imminent. I mentioned that to you before. I think the silver miners and gold and everything else. SIL is a silver miners ETF starting to crack as well. That's one I told you I had a price alert on today. SLVP is another global silver miners ETF. That one's breaking down. That one's a little bit more clearly below the trend line. Not solidly, but a little. You can see it there. And then I won't go into all of them. I just gave you the update there. So really, for these to play out, gold needs to break that level I just showed you on the 60-minute chart. And then silver, SLV, you pretty much had a divergent high right here. And just like gold, it's testing those recent lows. So if it takes that out, then it's probably going to come down here. And that's when the silver miner stocks will buckle. And if they do, guys, by the way, those are, if they break down, well, the majority of these, I did a video a couple weeks ago on the silver miners. Some I told you had already broken down, silver and gold miners. Newmont's broken down. That's one of the biggest miners, if not the biggest. AEM, these are the biggest miners right here, the gold and silver. And most of them are broken down. So the sell signal's already in play. It's still an active short. What else I wanted to cover? One more thing. Maybe that's it. I already had no reason to go into natural gas. I give you a detailed post today of that with some levels. I will mention this one because this is what I call it, NVIDIA's sidekick. Kind of its little, NVIDIA's Batman and SMCI is Robin. Tends to have, and this one I highlighted way back here. I first shorted it there. Then I mentioned covering it recently and then getting back in short, and it just broke down yesterday. And so this is the big level. I'm going to color it up for you. I have not wavered on my price target or the fact it'll be hit. It's just taken a while for the, because NVIDIA is not rolled over, but this one has long since peaked and is still off that high, months ago. Still down almost 40% after already dropping over 40. But that's the big level there. 690, lights out for this, especially if NVIDIA rolls over. NVIDIA, like I said, will most likely roll over, and correct, talking double digit, 10% plus drop down to at least that uptrend line I showed you earlier. And if this guy breaks 690, which I suspect it will, that's the price target I've had out here since February 16th right here. That was right. there. Yep, that was the day I shorted it right there with that bearish engulfing candle. There's a case where it didn't prove to be the topping candle, but then the technicals got even more bearish with a bearish rising wedge and a breakdown downtrend line. Oh, let me extend this downtrend line. Maybe they might come in and buy that back test if we get it, which we're on it right now. But either way, like I said, there's a lot of evidence that we could see, market may have topped and we may be heading to those 200-day moving averages I've been talking about now. And so, something like this, this is kind of a tuck it away short, as long as the charts are constructive with that price target, which would still be another 53% drop from where we're at now. Okay, I'm going to wrap it up here. We're at the 40-minute mark. Remember, as I often say, all these videos, any video on YouTube, you can go to the settings icon, little cog at the bottom right of the screen, and change the playback speed to 1.25, 1.5, 1.75. You can go up to 2.0. I usually watch videos, whether it's if I'm reviewing my own or going to any video on YouTube that, I'll go at least 1.5 speed or 1.75. You can always slow it down or go back to normal speed if you get to an area you're really trying to track. It just makes getting through these pretty quick. So, you can take down a 40-minute video in almost half the time. So, all right, guys, I'm going to get it out to you. And we'll continue to hunt for new trade ideas and anything that may change my outlook in the markets. But as of now, like I said, it's looking good, at least in the coming days to weeks, for more downside to at least the 200-day moving averages in the major indexes. This has been Randy Finney with Right Side of the Chart. Have a great day.